Well, thank you everyone for joining us again for our 30-minute power session. Just a reminder, we do these once a month, and we'll be covering a variety of different mortgage topics and real estate topics that would be relevant to our real estate agent partners in growing their business and making sure that they're providing the best advice and service to their clients. So today, we're excited. We're going to be discussing investor loan programs and non-QM loans in general. We have Christina Clark and Lynn Marino from our product team that will be presenting today for the DSCR program, as well as how to close in the name of an LLC for investors. So thanks again for joining. Just a reminder, we will be recording this, and we will have a question and answer session at the end. So just hold your questions to the end, and we'll make sure to get them all covered. But Lynn and Christina, I will let you take it away. Thanks so much for joining us.
Thank you for having us, and we're so appreciative to be here. We're going to discuss today some non-QM loans, specifically DSCR and some LLC options, hoping that it'll give you a good basis for starting to do these type of loans with Fairway. I want to, number one, thank everyone again for joining, just same as Richard. We want to give you some tools to close more loans for clients who don't fit the usual mortgage standard. These are non-standard loans. Atypical non-QM means it doesn't meet the mold. We're going to talk about investors, self-employed borrowers, and we're going to just begin now, dive in and see how we can get these loans to work for you. So we're going to begin by just explaining what a non-QM loan is. So again, they're mortgages that don't follow the standard underwriting criteria. So the true definition is, if you meet the GSE standards, if you follow your AUS, if you meet the seller guide, then you're a QM loan. If you don't, then you're non-QM. So it really does run the gamut of all these different definitions and all these different types of scenarios that wouldn't fit into the mold. So this is the easiest way to explain non-QM for these purposes. Again, we're going to stick to DSCR and LLCs, but there are a lot of other examples of what would fit into a non-QM scenario. So we just listed some of those so that you can have an awareness and know that those are other types of loans that we do here at Fairway quite often and that we can help you with. So we're going to get into DSCR. So DSCR is an enigma. It's a wonderful loan for self-employed borrowers and investors. And the reason that it's such a great option is because it doesn't really take into consideration the borrower's income. It's more about the property. Does the property cash flow? And it doesn't rely on personal income. It doesn't rely on, or it doesn't focus on anything except for what the property can do. What income can the property generate? And we're going to go over what that calculation looks like on the next slide. So the DSCR cash flow process is super simple. It's basically just taking the rental income against the loan payment, the PITI. So you divide the rental income by the loan payment and you get the DSCR ratio. Now, there are a lot of lenders, and I would say the average is about 1.25, and they want that ratio to be at or above 1.25. But we actually go below that threshold, and we start at 0.75 and go all the way up to the 1.30, I believe. Or excuse me, 1.30 plus. So anything above 1.30 is great. But we also go down to 0.75. The important thing to know here is, again, this isn't about the borrower. It's 100% about the property. The calculation is super simple. And we just did the math for you here so that you can have an example of how it works. Did we want to ask any questions? We want to save the questions for the end, correct?
Yep, we can save the questions for the end.
Perfect. Let's go on to LLC options. So we have a lot of LLC options. We have LLC options for DSCR, and we have LLC options for non-DSCR. A lot of our non-QM options have these LLC options, but we actually have some QM options that offer them as well. So that's just something to have in the back of your mind. The important things to know about the LLC options is if you have a loan that is for business purposes, like the DSCR, in general, you're going to have the LLC option, meaning the title can be vested within the LLC. The important thing to know with LLCs is that the managing member, whoever has the most authority or has the most signing restrictions or less restrictions, will be the person who will sign on behalf of the entity. Some of our investors do indicate that they have a maximum number of members. Typically, that number of members is 4. We don't really see entities that have more than 4 members. And if there isn't a member who owns greater than 25% of the entity, then the primary guarantor, the person who usually signs the documents, will be the person who will sign them for us for the loan. The LLC has to be domiciled in the United States. And we make sure that when we're underwriting these for DSCR or any business purpose loans, that we're looking at the individual entity owner. Number one, we look at their credit. We look at the income on non-DSCRs, but on DSCRs, we do the cash flow for the property and the assets. And that's really the crux of what these loans are all about. It's, again, they're business purpose loans. We want to keep it focused on the business with the exception of credit and assets. A personal guarantee will be required on 100% of these loans. And like power of attorneys are generally not permitted. In 100% of the LLC loans for DSCR and business purpose, it has to be an investment property. So this is where we get into the nut and bolts. You know, what's in it for me? How can we help you using DSCR, LLC, and other non-QM offerings to close more loans? So the first thing is there's no traditional DTI. So when we're using a DSCR loan, again, we're making sure the property cash flows. So you're not going to have a DTI problem because there is no DTI. There is no analyzing asset statements for, you know, buy now, pay later loans. There's no secrets that are going to creep up in your file that are going to go boom, you know, and all of a sudden your DTI doesn't work and your loan is falling apart and you're scrambling at the last minute. None of that is going to happen on these loans because it's not something that is considered. Faster loan approvals. That's always a bonus because a lot of realtors do have financing contingencies on their offers, and obviously we can remove those faster with less documentation. Less documentation, you can worry about less pitfalls, less surprises, and you can remove that contingency faster, and buyers are happy, sellers are happy, and we move through the process much faster, which equals closing more deals. So when you close more deals and you have more options, again, we have DSCRs for rentals and self-employed. We have bank statements, alt-doc loans. We have non-traditional borrowers. I did throw the non-warrantable condos in there just, again, for awareness. These are things that don't fit the traditional mold, which means more options, more loans that can close. And then the last slide is just the Wish team contact information. And we want to make sure that you had that front and center so that you can call Leslie or Richard with any questions that you may have regarding these options. And we are always there to support them and anything that you need. And I think we're ready for questions.
You have to definitely want to leave enough time so that I know these can be loan types that have a lot of questions. So feel free to unmute yourself. It looks like everybody here is muted right now, but if you do have specific questions, feel free to unmute, and Lynn and Christina would be happy to answer.
I'll ask a question. Lynn, you mentioned faster closings. What is the time frame that the realtor can expect, you know, that these types of loans would close, like a DSCR?
Well, we pride ourselves here at Fairway on fast closings, and I've seen them close in as little as, I don't want to set a expectation that is unrealistic, but I've seen them close in as few as 5 days. I've seen them close. I mean, when we're taking them from another business that maybe dropped the ball and we're closing, with all of the documentation, we can go front to back fairly quickly. I mean, it really comes down to how fast we can get the collateral appraised, and as soon as we can do that, the faster we can close. Richard, would you say that your average turn time is around 10 days less? 10 days or less?
Say for traditional loans, I'd say 10 to 14 days is pretty typical.
So this would be less than that.
So this would be less than that. Okay. And I guess in terms of kind of just the general, I guess, timeline, so you mentioned like the appraisal. I'm imagining this is as a pretty important piece in the puzzle in terms of the rental amount. I guess could you explain a little bit on how that rent is determined and I guess what factors are involved in terms of that piece of the puzzle?
Yeah, absolutely. So it's actually very similar to a traditional appraisal if it's long-term rent. So you'll get your typical rent schedules like you normally would on any other appraisal. So there's no difference there. We'll use market analysis and data. Just typical appraisal, the way that it's always done. Short-term rent, little bit different when it comes to the appraisal because Fannie Mae did come out with an update that indicated that appraisers should not be using the 1007 to report short-term rents. So now most of the short-term rental verification or confirmation that we would normally get in an appraisal, typically we now get from the AirDNA report. And the AirDNA report for short-term rent basically takes a market analysis of whatever market your short-term rental is in. And it basically says, this is the typical occupancy rate. This is the typical rental amount that we get for this. And it comes up with a total and a score. And based on that score and the total, we'll be able to use that AirDNA report to estimate what those rents will look like. Now, if it's a refinance, which wouldn't apply here because this is a realtor presentation, but if it was a refinance, we would use not taxes, but we would use history, right? The AirDNA would provide like an Airbnb or a VRBO history. We could use that. But on purchases, it becomes a little more difficult because if the current seller did not have a history, then we have to use estimated numbers, and it kind of limits what we can do, but we can still get it done.
And what if the property is already rented out? I guess if there's a history of rental, I guess, is there an option to use those numbers? Say that's better than the appraisal number that came out. I guess how does that work?
I'm going to toss a few questions over to Christy. Christy, would you like to field that one?
Yeah, so typically it would be if the rental property if the property that they're purchasing with the DSCR is already rented, and you want to use that number, then that lease would have to be assigned over to the current purchaser. Otherwise, it's going to go by usually the lesser of the two, the market rent or that lease. So it's going to be the 75% of the lesser of the two.
So is that what you would use if you did have an existing lease in place? Would you use those numbers to determine, the DSCR calculation, or would the appraisal that would be, obtained on the property, would that be the number that you would use? It might override the lease, or vice versa.
The appraisal on a purchase, they're going to use if there's a lease already executed in place, then usually they require it to be for 60 days from the note date, and a copy of that's required, or a transfer of the lease agreement. Some of the investors will permit that to be utilized. So it's going to depend on the investors. So there are some investors that do permit it, and there are some that do not. So either way, like Lynn said, it can be done. It's just going to be a matter of which investor will permit you to utilize that lease agreement and which one won't. But most of them
it has to make sense against the market too, because
Right.
if it's significantly higher than market, then you're going to ask yourself as an underwriter, right? So we're not underwriting, we're actually in credit policy. So we would not give you the nuts and bolts of how we would break that down. We would just give you generally what that looks like. But an underwriter can say, this really doesn't fit in the market. It's significantly higher than market. And unless you had a good reason why it's significantly higher than market, you're really going to want to use the more conservative approach when you're bringing the deal into underwriting to make sure that it works with that number. If it doesn't, then you're going to want to tell the underwriter, it doesn't work with that number. We have to use the market rent. This is why we should use the market rent. And then depending on the risk level of the rest of the loan, that's what that's going to look like. So that one is a little tougher. It's not impossible, but you're definitely going to want to do your due diligence going into that transaction.
And then down payment requirements, and I'm sure that's probably a question people are curious about as well. And I'm sure it varies. I know we have a lot of different investors that we work with for these programs, but is there a typical down payment required, and is DSCR or LLC being part of it? The DSCR ratio, does that have anything to do with it?
The LLC has nothing to do in regards to the LTV, so that's a plus. So the LTV is going to be based upon the loan amount and the credit score. So they can go all the way down. Some investors can go as high, I believe 80% is the maximum. I think we may have a couple, I'd have to go look, that do go a little higher, but I'm going to say the score is also based upon, the score is going to be based upon the LTV, the minimum credit score, and the loan amount. So you're going to have a wide variety of factors that are going to weigh in on that.
Okay, so it sounds like in general, 20% down is pretty standard.
Yeah, I think off the top of my head, I think that there was one that did do 85%, but I would have to go look and confirm that. So I would go conservative 80%.
And then say, I guess we're going ahead and go through the process. We get the appraisal back, and the rent number is different than what because of course you're starting the process, you don't have that exact number. So is there a best practice for, I guess, realtors and trying to kind of get a determination up front and setting the right expectation for the customer? And what could happen if maybe the rent is lower than what you initially anticipated? How could that impact the financing?
I would always go more conservative on the rent that you're going to utilize, because the pricing would be impacted based upon the scoring. Pricing is impacted based upon that DSCR score. So always go the most conservative. If it comes in a lot higher and it changes, then yay, win. You may get a lower rate for your borrower. You can redisclose it out to the borrower, but I would always go more conservative.
So just for clarification, when Christina just said pricing, she's referring to the interest rate. So the interest rate that a buyer would be able to get would be determined in a large part by those factors she just mentioned.
Correct.
One other thing, so non-QM and QM, basically QM stands for qualified mortgage, and Lynn touched on this earlier, but qualified mortgages are mortgages that pretty much fit the mold of what Fannie Mae and Freddie Mac likes, and that's generally speaking the majority of what the loans that we see in our marketplace. But these non-QM options are becoming so much more popular now that we have investors, i.e. other banks, that we can sell these loans to and that offer us these different programs. So the reason that we like to bring these power sessions to you is to give you exposure to them so that you know that there are easier paths in a lot of situations for these buyers to be able to get loans without having to drag their tax returns in. And we've seen things where we have investor clients where they might own 15 properties, and then they would have to provide tax returns and just a myriad of documents to be able to try and determine an income. And it's very difficult, when they're trying to get loans, they get very frustrated. And these are much easier paths for them to be able to get the financing, as you heard, very quick, just relying on a few factors, and boom, then the loan is done. So that was a big reason why we wanted to bring this to the realtors that we work with today.
It looks like we've got about 5 minutes left on our call. We want to be respectful of your time. I guess for those in the room, any other questions, I guess, regarding either the DSCR program, closing in an LLC? I know this was a kind of a crash course, but want to make sure that if you have specific questions that we can answer them.
We find that the realtors that we do work with often on the DSCR loans who work with a ton of investors or are investors themselves, they really enjoy the simplicity of the DSCR programs. So the one thing that I can say as a takeaway here is so much easier if you have an investor who has a ton of properties versus getting those 200-page tax returns. You know, this is completely different, and it's so much easier and so much faster. So if you do have someone who fits into the LTV of 80%, which a lot of them do, because they do have the cash, this is something that's definitely easier. And if your DTI is over and you know it's over, this is just another path to getting the loan done.
Yes, and I did just confirm that 80% is the max. I just went through them all and did confirm that it is 80% the maximum. And to go off what Lynn said, I did speak with the loan officer yesterday who was talking about obtaining all these tax returns. They filed extensions for the year, whatever, and they were purchasing an investment property 50% down. And I was like, hey, have you thought about doing the DSCR so you're not trying to figure out all those tax returns and you filed extensions, so now you need a P&L, like, and they ended up switching the loan to DSCR.
Great. Good story. Thank you.
All right, guys. Well, if no other questions, just a quick reminder, we are recording this, so you'll each get a copy of the recording. And I just want to thank you both, Lynn and Christina, for joining us today. That was super helpful, and hope everybody got something good out of this. And just a reminder, if you have any questions regarding the presentation or have a specific scenario you want to run by us for either the DSCR or if it's possible for your client closing an LLC, feel free to reach out to us and we'd be happy to help.
Thank you.
Hey guys.
Have a
Well, thanks
great day,
again. Hope
everyone.
everybody has a great day. Take care.
Bye-bye.